Hello everyone. Today we will discuss the monetary policy. It is basically concerned with the monetary system of the country. Hence, RBI plays a very crucial role in molding the economic character of the country. We can say monetary policy is the policy which is pertaining to the control of availability, cost, and use of money and credit with the help of monetary measures in order to achieve specific goals. In other words, we can say it is the deliberate effort made by the Reserve Bank of India to control money supply and credit conditions for achieving certain broad economic objectives. Monetary and credit policies operations are having some interrelated factors like availability of the credit and its flow, volume of the money, cost of borrowing, and general liquidity of the economy. There are two types of instruments of monetary policy, quantitative and qualitative. But before discussing these instruments, we will discuss some important objectives of monetary policy. The foremost and the first important objective is to promote the savings of the individuals. Then mobilize these savings to the borrowers. Giving incentives to the investments, it helps in curbing the inflation. It also provides extensive credit to the trade, agriculture, commerce. Next important objective is the neutrality of the money. Means there should be perfect stability of the money to achieve the neutrality goals. Means the quantity of the money is to be kept constant all the time. But there are some criticism that neutrality cannot assure price stability and a neutral money policy cannot be followed during the depression. Next objective is exchange rate stability, means the stability in the external value of the currency. Next, price stability means you have to keep the prices stable. A positive stable price policy is one which ensures the changes in the supply of money in such a way that the need of economic system are adequately met and prices are not allowed to fluctuate widely. Next objective is the full employment. The policy of full employment can be pursued through the monetary measures at it helps in achieving and maintaining the rates of savings and investment at the level which would ensure full employment. Next objective is economic growth. This is the primary goal of any economy. It means increase in the real national output of an economy. Hence, economic growth can be accelerated by increasing the rate of savings and investments. Hence, monetary policy aims at the objective of the economic growth. So, these are the important objectives of the monetary policy. Now we will discuss the important tools to control the availability of the credit as well as the flow of the credit for the specific purposes. So, the quantitative methods are also known as general methods. It includes bank rate, open market operations, cash reserve ratio, and statutory liquidity ratio. Cash reserve ratio and statutory liquidity ratio are the part of variable reserve ratios. So, now we will discuss each method one by one. Bank rate is the rate at which the RBI make advances to the commercial banks against approved securities or the first class securities. In inflation, RBI increases the bank rate in order to control the credit, whereas in deflation, RBI decreases the bank rate in order to control the money. During the inflation, when bank rate is increased, due to which the money in the economy get contracted, whereas in the inflation, bank rate is decreased so that the money in the economy get expand or pumping up the money is done during the deflation period. Next is variable reserve ratio. Commercial banks keep fraction of their deposit liabilities in form of cash or liquid. When it is kept in form of cash, then it is called cash reserve ratio. And when it is kept in form of liquid assets or approved securities, then it is called statutory liquidity ratio. Hence, commercial banks has to maintain these two important reserve ratios. So they have to keep cash with the RBI, and statutory liquidity ratio means they will keep the liquid asset with themselves. During the inflation, RBI increases the variable reserve ratios, whereas in deflation, RBI decreases variable reserve ratio. This causes the pumping of the money during the deflation as well as contraction of the money during the inflation. So, these are the two methods, and the third method is the open market operation. It means selling and purchasing of the approved government securities by the RBI in the money market. During the inflation, RBI sells the first class securities, whereas during the deflation, RBI started purchasing the first class securities. So, during inflation, when RBI sells the first class securities, then what will happen? The money in the economy get contracted. And during the deflation, when RBI purchases the first class securities, the money in the economy get expanded. So, during the inflation, what we need to do? We have to contract the credit or the flow of the money. Whereas during the deflation, RBI helps in pumping the money or availability of the credit in the economy. So these are the important quantitative methods. Now we will study the qualitative or the selective methods. As I told you, the qualitative methods are used to control the flow of credit for the specific purposes. There are different measures like rationing of credit, margin requirement, regulation of consumer credit, direct action, and moral suasion. Credit rationing means limiting the amount available to the each applicant as credit. Whereas changes in the margin requirement against security means margin is the difference between the value of security offered and amount borrowed against this security. So, this system is particularly intended in controlling the volume of credit used for the speculative purposes. Next is regulation of the consumer credit. Means it enables the consumer to buy goods and services immediately and pay for them later. Hence, the regulation of consumer credit intends to regulate credit for the purchase of consumer goods. So, it includes the banning or allowing the credit for the purchase of certain consumer goods. Next, direct action. It means if the commercial banks persist a policy which is in the conflict with the declared policy of the RBI, the central bank may take direct actions. Next, moral suasion. It is a milder form of control which can be used both as a general instrument as well as selective one. The central bank may issue advices regarding the credit policy to be carried out by the commercial banks. Moral suasion is the most actively and consistently used technique of the monetary policy. It is in the form of writing letters, holding discussions between the RBI and the banks about the trends in the economy in the general. So in this way, we can control the availability of the credit as well as flow of the credit in the economy. I hope you all are able to understand now what is monetary policy and what are the different instruments which controls the availability and the flow of credit. If you have any queries, then you can put the comment in the comment box. Thank you for watching. Keep sharing my channel. Do like and subscribe it. Thank you so much. Take care.